Did you know that many candidates fail the AACE Certified Cost Professional exam not because the calculations are too difficult, but because they misunderstand the core principles behind total cost management? A small gap in your foundation can lead to costly mistakes on multiple questions throughout the exam. In this complete study guide, you'll build that foundation step by step so every topic that follows makes more sense. Be sure to check the description, where you can download a free study guide featuring some of the most important exam questions to strengthen your preparation. Now, let's begin with Section 1. In this lesson, you'll learn the essential concepts of total cost management, key cost engineering terminology, and the core principles that every certified cost professional must understand. These fundamentals are the backbone of the entire CCP exam and will help you answer questions with greater confidence while preparing you for the more advanced topics covered in the remaining sections of this course. Let us start by defining total cost management, often abbreviated as TCM in the AACE framework. Total cost management is a systematic approach to managing resources, costs, profitability, and risk throughout the entire lifecycle of an enterprise asset. In simple terms, it means applying engineering and management principles to make sure money is spent wisely from project initiation all the way to decommissioning. On your exam, remember that TCM covers both asset management and project control, connecting overall business strategy with daily project execution. Next, we must clarify what cost engineering actually is and how it fits into total cost management. Cost engineering is the application of scientific principles and techniques to problems of business planning, cost estimating, economic evaluation, schedule control, and project management. A common mistake candidates make on the exam is thinking cost engineering is just accounting. While accounting records historical transactions, cost engineering focuses on predicting, planning, and managing future project outcomes. Within the total cost management framework, you will encounter two main sub-processes known as strategic asset management and project control. Strategic asset management guides how an organization chooses to invest its capital to create maximum value over time. Project control, on the other hand, is the process of taking those chosen investments and managing their scope, cost, and schedule during project execution. The exam often tests your ability to distinguish between these two processes, so remember that strategic asset management determines what projects to do, while project control ensures projects are done correctly. Now let us examine how costs are classified, starting with direct costs and indirect costs. Direct costs are expenses that can be specifically tracked and attributed to a specific project work item or task. For example, buying concrete for a building foundation or paying wages to field workers on site are direct costs. On the exam, if a cost can be directly measured and assigned to a specific physical deliverable, it should always be classified as a direct cost. In contrast, indirect costs are expenses that support the overall project but cannot be tied directly to a single work package. Examples include office trailer rentals, administrative support salaries, legal fees, and site utility bills. Exam questions often present scenarios where you must categorize project expenditures, so keep in mind that indirect costs are shared operational expenses necessary to complete the project work. Another fundamental distinction you must master for the exam is the difference between fixed costs and variable costs. Fixed costs are expenses that remain constant regardless of the volume of work produced within a given period. Renting a piece of heavy equipment on a flat monthly fee is a classic example of a fixed cost. No matter how many hours the machine operates during that month, the rental cost stays exactly the same. Variable costs, on the other hand, change in direct proportion to the volume of work completed or the level of activity. For instance, the total cost of fuel used by site machinery increases as the equipment operates for more hours. On the CCP exam, you may need to separate fixed and variable components when analyzing project budgets, so remember that variable costs rise and fall directly with activity levels. You will also encounter recurring costs and non-recurring costs on the certification exam. Recurring costs are expenses that repeat on a periodic basis throughout the project lifecycle, such as weekly site inspections or monthly software subscriptions. Non-recurring costs are one-time expenses that occur only once during the project, such as purchasing a customized piece of equipment or paying an initial permit fee. Recognizing these patterns helps cost professionals build realistic, time-phased project budgets. Two economic cost concepts that frequently appear in exam questions are sunk costs and opportunity costs. A sunk cost is money that has already been spent and cannot be recovered by any future decision. A common trap for candidates is including sunk costs in future decision analysis, but economically, sunk costs should always be ignored when evaluating new project alternatives. Opportunity cost, by contrast, represents the value of the next best alternative that you give up when making a choice. For example, if your company chooses to invest capital in Project A, the opportunity cost is the potential profit lost by not investing in Project B. The CCP exam tests whether you understand that capital resources are limited, meaning every project selection decision involves an opportunity cost. To manage costs effectively across an enterprise, cost engineers rely on a structure called the Code of Accounts, or COA. A code of accounts is a systematic numbering system used to code and categorize costs, activities, and resources across an organization. By assigning a unique code to each expenditure, you ensure that cost data is tracked consistently across different projects and accounting systems. On the exam, remember that a well-designed code of accounts bridges project cost control with financial accounting. Let us now explore capital expenditures, commonly known as CapEx, and operational expenditures, known as OpEx. CapEx refers to funds used by a company to acquire, upgrade, or maintain long-term physical assets like buildings, machinery, or land. These investments are capitalized on the balance sheet and depreciated over time. Understanding CapEx is essential because cost engineers spend significant effort estimating and controlling these initial project investments. OpEx, on the other hand, refers to the ongoing day-to-day expenses required to keep an asset or business running after initial deployment. Examples of OpEx include routine maintenance, utility bills, and facility management salaries. On the exam, you must clearly distinguish between CapEx, which builds or acquires an asset, and OpEx, which maintains and operates that asset over its practical lifespan. This brings us to the concept of lifecycle costing, which is a core pillar of total cost management. Life cycle costing evaluates the total cost of owning an asset from its initial conceptual design, through acquisition and operation, all the way to final disposal. Exam questions often highlight that focusing only on low initial capital costs can lead to higher overall life cycle costs due to poor quality or high maintenance demands. A critical element of cost engineering is understanding how project lifecycle phases affect cost control. In the early initiation and conceptual phases, project cost uncertainty is extremely high, but the ability to influence total cost is at its peak. As the project progresses into detailed engineering and construction, the cost to make changes increases dramatically, while your ability to influence final outcomes drops sharply. This relationship between cost influence and cost to change is a classic concept tested on the CCP exam. Early decisions made during front-end planning have the biggest economic impact on the project life cycle. Candidates often miss exam questions by assuming that cost control occurs mainly during construction, whereas the most effective cost control actually takes place during early project definition. Scope definition serves as the ultimate foundation for all project cost management activities. Project scope defines the specific work, deliverables, and boundaries required to deliver a product or service successfully. If the scope is poorly defined, cost estimates become unreliable and budget overruns become almost inevitable. On the exam, always remember that scope, schedule, and budget are tightly interconnected in the classic project management triangle. As you prepare for exam questions on cost principles, keep in mind that questions often test your practical understanding rather than raw memorization. Pay close attention to scenario details, such as whether a cost is fixed or variable, or whether a decision involves sunk costs. Practice identifying the core economic principles within real-world project scenarios, as this analytical mindset will carry you through the entire test. Congratulations on completing this foundational section on total cost management and cost engineering principles. You have taken a big step forward in your exam preparation, and to lock in what you have learned, please complete the attached practice test included with this lesson. Working through practice questions builds your retention, improves your test-taking speed, and actively prepares you for exam readiness. Take the test now to test your knowledge, and I will see you in the next section where we will dive into cost estimating and budget development. Welcome to Section 2 of our AACE Certified Cost Professional Prep course, where we dive deep into cost estimating and budget development. In this lesson, you will learn how to build reliable project estimates from early concept sketches all the way to detailed baseline budgets. Understanding how to accurately predict project costs is one of the most critical skills tested on the CCP exam and a core competency for any cost professional. Get ready to explore proven estimating methodologies, discover how to manage scope uncertainty, and take another massive step toward mastering your certification. Let us begin by defining what a cost estimate actually is in the context of the AACE framework. A cost estimate is a predictive process used to quantify, cost, and price the resources required by the scope of an investment option, activity, or project. It is important to understand for the exam that an estimate is never a single absolute number, but rather a realistic assessment of probable costs based on the information available at that specific moment in time. The accuracy of any cost estimate depends entirely on the level of scope definition available when the estimate is created. AACE International classifies estimates into 5 distinct classes, ranging from Class 5 to Class 1, based primarily on the maturity level of the project scope. The exam will heavily test your knowledge of these estimate classes, so remember that a Class 5 estimate is the least defined, while a Class 1 estimate is the most detailed and accurate. Let us look at a Class 5 estimate, which is typically used for early conceptual screening or high-level business planning. At this stage, the project scope definition is very low, usually between 0 and 2% complete, meaning the cost estimator relies heavily on historical data and broad assumptions. Because so little is known about the specific project details, Class 5 estimates have the widest range of expected accuracy, often fluctuating wildly above or below the final project cost. As the project progresses into detailed engineering and the scope definition reaches 50 to 100% complete, you will create a Class 1 estimate. A Class 1 estimate is fully developed, typically used for final budget authorization or creating a firm contract bid for construction. On the exam, you should associate Class 1 estimates with definitive pricing, highly detailed material takeoffs, and a very narrow range of expected accuracy. To build these estimates, cost engineers use several different methodologies, starting with the analogous estimating technique. Analogous estimating, also known as top-down estimating, uses the historical cost of a similar past project as the baseline for estimating the cost of the current project. This method is quick and inexpensive to perform, making it highly useful during Class 5 and Class 4 estimates when detailed design information is not yet available. While analogous estimating is fast, candidates must remember its main limitation for the exam, which is a significantly lower level of accuracy. Because no two projects are exactly identical, you must carefully adjust the historical cost data to account for differences in location, time, size, and complexity. If you simply copy a past budget without analyzing these project-specific differences, your new estimate will be deeply flawed. Another powerful method tested on the exam is parametric estimating, which uses a statistical relationship between historical data and other variables to calculate a cost. For example, if historical records show that building a commercial warehouse costs $100 per square foot, you can multiply that rate by the square footage of your new warehouse to find the total estimated cost. Parametric estimating is highly effective when you have accurate historical unit rates and a well-defined physical parameter to measure against. When a project requires the highest level of accuracy, cost professionals turn to definitive estimating, commonly referred to as bottom-up estimating. In bottom-up estimating, you calculate the cost of individual, low-level work packages or activities, and then roll those detailed costs up to get the total project budget. The exam will expect you to know that while this method produces the most reliable figures, it requires significant time, effort, and a fully matured project scope to execute properly. A crucial step in building a definitive estimate is performing a quantity takeoff, which involves measuring and counting the exact materials required directly from the project drawings. Cost estimators methodically review engineering blueprints to quantify every linear foot of pipe, cubic yard of concrete, or ton of steel needed for construction. Your accuracy during the takeoff process directly impacts the reliability of your final budget, as missing materials will quickly lead to cost overruns during execution. Once quantities are established, estimators must apply accurate pricing to those materials, which involves gathering current market data, supplier quotes, and internal labor rates. It is vital to separate direct costs, like raw materials and field labor, from indirect costs, like site overhead and equipment rentals. On the certification exam, correctly matching quantified materials with appropriate unit prices is considered a fundamental capability for any competent cost professional. You must also account for labor productivity, which measures how efficiently workers can complete a specific task under current project conditions. Productivity can be heavily impacted by factors like extreme weather, site overcrowding, poor supervision, or a lack of specialized skills in the local workforce. For the exam, remember that failing to adjust standard labor rates for realistic site conditions is a very common cause of blown project budgets. After calculating the base costs for materials, labor, and equipment, you must factor in cost escalation, which accounts for changes in price levels over time. Inflation naturally causes the price of goods and services to rise, meaning materials purchased 3 years into a long project will naturally cost more than they do today. Exam questions frequently require you to apply escalation rates to long-term projects to ensure the final budget reflects actual future purchasing power. Even with the best estimating techniques, every project faces the reality of scope uncertainty and unknown risks. To protect the project baseline, cost engineers use contingency, which is an explicit amount of money added to the base estimate to cover known unknowns. Contingency is not a slush fund for adding brand new project scope, but rather a calculated financial reserve designed to cover expected variations in the estimated work. It is incredibly important to differentiate contingency from management reserve, as this is a frequent and tricky topic on the CCP exam. While contingency covers foreseeable risks within the defined project scope, management reserve is held specifically for unknown unknowns, or completely unforeseeable events. On the exam, remember that the project manager typically controls the contingency budget, but management reserve is almost always controlled by upper-level executive management. Once the total estimate is finalized, reviewed, and officially approved by stakeholders, it becomes the cost baseline. The cost baseline is the approved, time-phased budget that project performance will be measured and controlled against during the entire execution phase. A major exam concept to remember is that you cannot simply change the cost baseline whenever a project overruns, as baselines can only be modified through a formal, documented change control process. The final step in budget development is cash flow forecasting, which maps out exactly when project funds will be spent over time. Even if a project is highly profitable on paper, it can fail instantly if the company runs out of cash to pay contractors during a heavy construction month. Understanding the time-phased timing of expenditures ensures that financing is available precisely when project bills become due, keeping the project moving forward smoothly. A common trap for candidates on the exam is assuming that estimating ends once the baseline budget is approved. In reality, cost estimating is an iterative process, meaning estimates must be continually refined, updated, and re-evaluated as new information becomes available during the project lifecycle. A successful cost professional constantly compares actual field spending against early estimates to improve future predictive accuracy for the entire organization. When approaching estimating questions on the exam, always look for clues about the project's current lifecycle phase and the maturity of its scope. If the scenario describes early conceptual planning, lean toward analogous or parametric methods, but if it describes finalized blueprints, expect to use bottom-up calculations. Connecting the right estimating tool to the correct project phase is the absolute secret to mastering this section of the test. Congratulations on completing this crucial section on cost estimating and budget development. You have added some very powerful tools to your cost engineering toolkit, and to reinforce these new concepts, please complete the attached practice test included with this lesson. Working through these practice questions improves your long-term retention and directly builds your exam readiness by simulating real test scenarios. Take a moment to challenge yourself with the practice test now, and I will see you in the next section where we will tackle planning, scheduling, and work breakdown structures. Welcome to Section 3 of our AACE Certified Cost Professional Prep course, where we explore the essential mechanics of project planning, scheduling, and scope decomposition. In this lesson, you will master the creation of work breakdown structures and learn how to perform critical path method calculations using precedence diagramming. Understanding how to connect project scope with time management is critical because schedule delays almost always result in massive cost overruns. Get ready to learn how to sequence project activities, identify schedule risks, and build the foundational tools that will help you ace the exam. The first step in effective project planning is defining the scope of work through a work breakdown structure, commonly known as a WBS. A WBS is a hierarchical, deliverable-oriented decomposition of the entire project scope into smaller, more manageable components. For the exam, think of the WBS as a visual family tree for your project, breaking down massive deliverables into smaller chunks until you reach the lowest level of manageable work. That lowest level of a work breakdown structure is called the work package. A work package is a distinct, measurable unit of work that can be easily assigned to a specific team or contractor for execution. When taking the CCP exam, remember that work packages are where cost and schedule estimates are actually calculated, making them the ultimate building blocks of your entire project baseline. One extremely important rule for creating a work breakdown structure is the 100% rule. This rule states that the WBS must capture 100% of the work defined by the project scope, and absolutely nothing more. If a task or deliverable is not included in the WBS, it simply is not part of the project, which is a vital concept for preventing scope creep during execution. To accompany the visual hierarchy of the work breakdown structure, cost professionals create a WBS dictionary. The WBS dictionary is a detailed document that provides a specific description, acceptance criteria, and resource requirements for every single work package in the project. The exam often tests your knowledge of this document because it prevents misunderstandings by telling contractors exactly what is included in their assigned scope of work. Once the scope is fully decomposed into work packages, you must break those packages down further into specific schedule activities. An activity is a distinct, scheduled portion of work performed during the course of a project, complete with its own estimated duration. Moving from the WBS to the project schedule means transitioning your focus from physical deliverables to the actual actions required to build those deliverables. After identifying all project activities, the next step is determining their logical sequence, which is known as precedence diagramming. Precedence diagramming involves linking activities together based on their dependencies, mapping out exactly which tasks must happen before others can begin. On the exam, you will need to understand how these logical relationships create a network diagram that dictates the flow of project execution over time. The most common logical relationship you will encounter in precedence diagramming is the finish-to-start relationship. In a finish-to-start dependency, the predecessor activity must completely finish before the successor activity can start. For example, you must finish pouring a concrete foundation before you can start framing the walls, making this the most logical and widely used dependency in project scheduling. You should also be familiar with start-to-start relationships, which allow two activities to begin simultaneously or with a slight delay between them. For instance, once you start digging a long trench, you can start laying pipe in the completed sections without waiting for the entire trench to be finished. Exam scenarios often use start-to-start relationships to show how project managers can compress a schedule by overlapping tasks safely. To accurately calculate the project timeline, you must estimate the duration of every single activity in your network diagram. Activity duration is simply the amount of time, usually measured in days or weeks, that it will take to complete a specific task given the resources available. Remember for the exam that duration estimates must account for practical constraints like weekends, holidays, and realistic labor productivity rates, rather than assuming perfect weather and perfect working conditions. With durations and dependencies established, you can perform a critical path method calculation, often abbreviated as CPM. The critical path method is a mathematical algorithm used to calculate the longest sequence of dependent activities in your project schedule. Mastering CPM is absolutely essential for the CCP exam, as you will definitely be asked to calculate early start dates, late finish dates, and overall project duration. The critical path itself is defined as the specific sequence of activities that determines the shortest possible time in which the project can be completed. Any delay to an activity on the critical path will directly delay the final completion date of the entire project. Exam questions frequently test your ability to identify the critical path. so always look for the continuous chain of activities that has zero scheduling flexibility. That scheduling flexibility is mathematically referred to as float, or sometimes called slack, in CPM terminology. Total float is the amount of time an activity can be delayed from its early start date without delaying the final project completion date. Calculating total float is a major exam topic because it tells project managers which tasks need strict supervision and which tasks have a little breathing room. It is also important to understand free float, which is a slightly different concept from total float. Free float is the amount of time an activity can be delayed without delaying the early start date of its immediate successor activity. On the exam, clearly distinguish between total float, which protects the entire project deadline, and free float, which simply protects the start of the very next task in the network. When performing CPM calculations on the exam, you will use a technique called the forward pass to determine early start and early finish dates. The forward pass involves adding activity durations through the network diagram from the beginning of the project to the end. This mathematical pass calculates the absolute earliest time each activity can occur, ultimately revealing the earliest possible project completion date. After completing the forward pass, you must immediately perform a backward pass to find the late start and late finish dates. The backward pass starts at the final project completion date and subtracts activity durations backward through the network diagram to the beginning. The exam expects you to know that mathematically subtracting the early dates from the late dates is exactly how you calculate total float for each activity. Sometimes a project manager must compress the schedule to meet an aggressive deadline, using a technique called fast tracking. Fast tracking involves taking critical path activities that were originally planned to happen sequentially and overlapping them to save time. While this speeds up the schedule, the exam will want you to recognize that fast tracking heavily increases project risk because overlapping tasks often lead to rework and coordination errors. Another schedule compression technique you will be tested on is crashing, which involves adding more resources to critical path activities to shorten their duration. Crashing might mean authorizing overtime pay, hiring additional labor crews, or paying for expedited material shipping. The key exam concept here is that crashing always increases project costs, so you must carefully analyze whether the time saved is worth the extra money spent. As you tackle scheduling questions on the CCP exam, I highly recommend drawing out quick network diagrams on your scratch paper to visualize the dependencies. Do not try to perform forward and backward pass calculations entirely in your head, as simple arithmetic mistakes can cost you easy points. Take your time, systematically trace the paths through the diagram, and always double-check your critical path identification before selecting your final answer. Congratulations on completing this heavily analytical section on planning, scheduling, and work breakdown structures. You have just mastered some of the most calculation-heavy concepts on the exam, and to secure this knowledge, please complete the attached practice test. Working through practice questions improves your retention, solidifies your CPM calculation skills, and builds total exam readiness. The practice test is included with this lesson, so challenge yourself right now through active learning, and I will see you in the next section where we cover earned value management. Welcome to Section 4 of our AACE Certified Cost Professional Prep course, where we tackle the incredibly powerful tool known as earned value management. In this lesson, you will learn how to measure, analyze, and control true project performance using standardized industry metrics. Understanding earned value is vital because it is heavily tested on the CCP exam and serves as the ultimate benchmark for forecasting final project costs and completion dates. Get ready to master these essential formulas, uncover the real story behind your project data, and take a massive leap toward achieving your certification. Earned value management, or EVM, is a systematic methodology used to integrate project scope, schedule, and cost into a single unified performance measurement baseline. Instead of just looking at how much money you have spent compared to your budget, EVM objectively measures the actual physical work that has been completed on the job site. For the exam, remember that EVM answers the critical question of what you actually got for the money you just spent. To use earned value management, you must first understand its three foundational metrics, starting with planned value. Planned value, often abbreviated as PV, represents the authorized budget assigned to the specific work you originally scheduled to accomplish by a certain date. Think of it as the baseline plan, telling you exactly where the project should be in terms of both time and money on any given day. The second foundational metric is actual cost, which is abbreviated as AC. Actual cost is quite simply the total amount of money that has actually been spent to complete the work up to a specific point in time. On the exam, actual cost represents the real-world invoices, payroll, and material receipts that have been paid out, regardless of what the original budget planned for those items. The third and most important metric is earned value, abbreviated as EV. Earned value represents the quantifiable value of the work actually performed, expressed in terms of the original approved budget assigned to that exact work. When you take the exam, always remember that earned value converts physical progress, like pouring 50 yards of concrete, into a dollar amount so you can accurately compare it against your baseline. With these three metrics, you can calculate your performance variances, starting with cost variance. Cost variance, or CV, is calculated by subtracting your actual cost from your earned value. A positive cost variance means your project is coming in under budget, which is great news, while a negative cost variance means you are officially over budget. Next is the schedule variance, which is abbreviated as SV. You calculate schedule variance by subtracting your planned value from your earned value. On the CCP exam, a positive schedule variance indicates that you are ahead of schedule, while a negative schedule variance serves as a massive warning sign that your project is falling behind. Variances show you the raw dollar amounts, but performance indices show you project efficiency, starting with the Cost Performance Index. The Cost Performance Index, or CPI, is calculated by dividing your earned value by your actual cost. If your CPI is greater than 1, you are getting more than $1 of value for every dollar spent, making this the single most critical metric to monitor for financial health. Similarly, the Schedule Performance Index, or SPI, measures your time efficiency. You find the SPI by dividing your earned value by your planned value. An SPI greater than 1 means your team is working faster than originally planned, and you will definitely need to calculate and interpret both the CPI and SPI on your certification exam. To forecast future project outcomes, you must know your total baseline budget, which is called the budget at completion, or BAC. The budget at completion is simply the sum of all planned values established at the very beginning of the project. It represents the total amount of money you originally expected the entire project to cost when it was fully approved. Using your current performance data, you can forecast the final expected cost of the project, which is called the estimate at completion, or EAC. The EAC tells project stakeholders how much money they will actually need to finish the job based on current realities, not past wishes. Calculating different variations of the EAC based on specific project scenarios is heavily tested on the AACE exam. The most common formula for calculating the estimate at completion assumes that your current cost performance will continue for the rest of the project. To find this, you simply divide your original budget at completion by your current cost performance index. This calculation tells you that if you have been losing money due to poor efficiency so far, you will likely continue losing money at that exact same rate until the end. Another vital forecasting metric is the estimate to complete, or etc. While the EAC predicts the total final cost, the estimate to complete tells you exactly how much more money you need from today forward to finish the remaining work. On the exam, you can quickly find the etc. by subtracting your actual costs to date from your newly calculated estimate at completion. Once you have your new forecast, you will want to know how far off you will be from your original budget, which is called the variance at completion, or VAC. You calculate the VAC by subtracting your estimate at completion from your original budget at completion. A negative VAC is a massive red flag, alerting management that the project will require additional funding to reach the finish line. The final major EVM calculation you need for the exam is the To-Complete Performance Index, known as TCPI. The TCPI calculates the exact level of cost efficiency your team must achieve on all remaining work to hit a specific financial goal, like the original budget. Think of it as a speedometer telling you exactly how hard your team needs to work to save a failing project. If your calculated TCPI is greater than 1, it means your team must work significantly harder and more efficiently than they have been to meet the budget target. If the TCPI is incredibly high, say above 1.2, cost engineers generally consider the original budget to be completely unachievable. Exam scenarios often ask you to interpret a high TCPI to determine if a project needs a totally revised budget baseline. Measuring physical progress to calculate earned value can sometimes be subjective, so cost engineers use discrete measurement rules to stay objective. A popular method tested on the exam is the 50-50 rule, where a task is credited with 50% of its value the moment it starts, and the remaining 50% only when it fully finishes. This prevents project managers from overly optimistic reporting when tasks are stuck at 99% complete for weeks. Not all work produces tangible, measurable deliverables, which brings us to level of effort activities, or LEW. Level of effort is used to measure support tasks like project management, site security, or administrative work that do not produce a physical product. On the exam, remember that earned value for level of effort tasks is simply equal to their planned value, because their progress is tied directly to the passage of time. When you approach earned value questions on the exam, the most critical step is carefully extracting the PV, EV, and AC values from the word problem. Many candidates fail simply because they mix up planned value and earned value when reading a stressful scenario. Take a deep breath, write down the 3 core metrics on your scratch paper first, and then apply your memorized formulas systematically. Congratulations on completing this highly analytical section on earned value management and project performance control. You have just learned the most important mathematical framework on the entire exam, and I strongly encourage you to complete the attached practice test to lock in these formulas. Practicing these calculations builds deep retention, dramatically improves your exam readiness, and is completely included with this lesson. Dive into those practice questions now for some active learning, and I will see you in the next section where we explore economic analysis and financial management. Welcome to Section 5 of our AACE Certified Cost Professional Prep course, where we shift our focus to economic analysis, financial management, and risk assessment. In this lesson, you will learn how to evaluate major capital investments, apply financial decision-making tools, and mathematically analyze project risks. Understanding these concepts is vital because cost professionals do more than just track budgets. They help executives decide which projects are actually worth funding in the first place. Get ready to explore the time value of money, master key investment formulas, and take another massive step toward dominating your certification exam. The foundation of all financial decision-making on the exam is a concept called the time value of money. This principle states that a single dollar in your hand today is worth more than a dollar promised to you in the future. This happens because the money you have right now can be invested immediately to earn interest and grow over time. On the exam, you must always account for this effect when comparing projects that generate cash flows over long periods of time. To calculate the time value of money, we use a specific percentage known as the interest rate or discount rate. The interest rate represents the cost of borrowing money or the expected return on a capital investment. When calculating future costs on the certification exam, you will apply this rate to determine exactly how much an investment will grow or shrink in value as the years pass. One of the most common calculations you will face is finding the present value of a future cash flow. Present value tells you exactly how much a specific amount of future money is worth in today's dollars, given a certain interest rate. For example, if a project will earn $100,000 5 years from now, calculating the present value tells you what that exact future payout is worth to your company today. Conversely, you will also need to calculate the future value of money that you currently hold. Future value measures how much a present sum of money will be worth at a specific date in the future when invested at a given interest rate. Exam scenarios often ask you to calculate future value to determine if a long-term capital investment will generate enough wealth to cover its initial startup costs. When comparing multiple complex projects, cost professionals rely heavily on a metric called net present value, or NPV. Net present value is the sum of all incoming and outgoing cash flows over the entire life of a project, discounted back to their present value in today's dollars. If the final calculated NPV is a positive number, the project is considered a profitable investment that will add real wealth to the organization. On the exam, you must clearly understand the strict financial rule for using net present value. If a project has an NPV greater than 0, you should accept the project. If a project has an NPV less than 0, you should reject it, because it will destroy company value. When faced with a choice between two mutually exclusive projects, you should always choose the project that offers the highest positive net present value. Another critical financial metric you will be tested on is the internal rate of return, commonly known as IRR. The internal rate of return is simply the specific discount rate that makes the net present value of a project equal to exactly zero. Think of the IRR as the true, natural interest rate that a project is expected to generate based purely on its own estimated cash flows. To use the internal rate of return effectively, a company must compare it against their minimum acceptable rate of return, which is also called the hurdle rate. The hurdle rate is the lowest percentage of profit a company is willing to accept before they will fund a project. On the exam, remember that if a project's IRR is higher than the company hurdle rate, the project is a good investment and should be strongly considered. You should also be familiar with the benefit-cost ratio, which is a simpler way to compare investment options. The benefit-cost ratio divides the present value of all expected project benefits by the present value of all project costs. If the resulting ratio is greater than 1, it means the financial benefits outweigh the costs, making it a highly attractive metric for evaluating government or public sector infrastructure projects on the exam. While complex formulas are great, management also loves a simple metric called the payback period. The payback period is the exact amount of time it takes for a project to generate enough cash to recover its initial capital investment. While it is easy to understand, the exam expects you to know its fatal flaw, which is that the payback period completely ignores the time value of money and any profits made after the initial investment is recovered. Moving from investments to accounting, you must understand how physical assets lose value over time, a process known as depreciation. Depreciation is a tax and accounting concept that allows companies to deduct the cost of a physical asset slowly over its useful life, rather than taking a massive loss all in year one. Understanding depreciation schedules is vital because these deductions heavily impact a project's annual cash flow and tax liabilities. The most basic method you will use on the exam is straight-line depreciation. In straight-line depreciation, an asset loses an equal, fixed amount of value every single year until it reaches its final salvage value. It is the easiest calculation to perform on the test, simply dividing the total depreciable cost by the expected number of years the asset will be actively used. However, companies often prefer accelerated depreciation methods because they provide larger tax breaks during the early years of an asset's life. The exam frequently mentions MACRS, which stands for the Modified Accelerated Cost Recovery System, a standard depreciation method used in the United States. Remember that accelerated methods do not change the total amount depreciated over the life of the asset, they just allow a company to claim those valuable tax deductions much faster. Now that you understand the financial rewards, we must explore the threats to those rewards through project risk management. Risk is an uncertain event or condition that, if it occurs, has a positive or negative effect on one or more project objectives. A major trap for exam candidates is thinking risk is always bad, but cost engineers also look for positive risks, known as opportunities, that can actually save time and money. During the risk assessment process, you will encounter both qualitative and quantitative analysis. Qualitative risk analysis is a subjective process that ranks risks based on their probability of occurring and the severity of their impact, often using a simple color-coded matrix. Quantitative risk analysis, on the other hand, is highly numerical, using mathematical models to calculate the exact dollar impact a risk will have on the project budget. The primary tool for quantitative risk analysis on the CCP exam is expected monetary value, or EMV. You calculate expected monetary value by multiplying the probability of a risk occurring by the financial impact it will cause. For example, if a weather delay has a 10% chance of happening and would cost $50,000, the EMV for that specific risk is exactly $5,000. Cost engineers use expected monetary value to build decision trees, which visually map out complex choices when multiple risks are involved. A decision tree helps management compare the financial outcomes of different choices by calculating the combined EMV of all potential paths. On the exam, you may need to navigate a simple decision tree to recommend the most cost-effective path based strictly on the highest positive expected monetary value. Finally, You must decide how to handle these identified risks by choosing a specific risk response strategy. You can choose to avoid the risk entirely by changing the project plan, transfer the financial burden to an insurance company, mitigate the impact through early safety training, or simply accept the risk and use your contingency budget. The exam will give you scenario-based questions asking you to identify which response strategy a project manager is actively using. Congratulations on completing this challenging section on economic analysis, financial management, and risk assessment. You have successfully added high-level financial decision-making and mathematical risk analysis to your skill set. To truly master these critical investment formulas, please complete the attached practice test included with this lesson. Actively solving these math problems improves your retention, locks in your exam readiness, and prepares you for success. Dive into the practice test now, and I will see you in our final section covering project execution, contracting, and professional ethics. Welcome to Section 6 of our AACE Certified Cost Professional Prep course, where we bring everything together through project execution, contracting, and professional ethics. In this final lesson, you will learn how to navigate contract types, manage project changes, resolve disputes, and uphold the highest ethical standards. Understanding these leadership and administrative concepts is vital because building a great estimate means nothing if the project fails due to a bad contract. Get ready to master risk allocation, explore the legal side of cost engineering, and take your final step toward total exam readiness. As a project transitions from the planning phase into active execution, the focus of the cost professional shifts heavily toward contract administration. A contract is simply a legally binding agreement between two or more parties, typically a project owner and a contractor. On the exam, you must remember that the primary purpose of any contract is to clearly define the scope of work and establish exactly how risks will be shared between those parties. For a contract to be considered legally valid and enforceable, it must contain a few essential elements, starting with an offer and an acceptance. One party must offer to perform a specific service, and the other party must officially accept those exact terms without modification. Furthermore, there must be consideration